Hello, future CMAs, and welcome. I am so glad you're here. I know studying for Part 1 is a huge commitment, and you're putting in the work, which is awesome. Today, we're going to tackle a topic that is absolutely critical for the exam, but also for understanding the real health of any business, the statement of cash flows. So let's dive right in.
It's the classic accounting riddle, isn't it? A company's income statement shows millions in net income. They look great on paper, but suddenly they can't pay their bills and they have to shut down. How on earth is that possible? Well, the answer is all about the massive difference between profit and actual physical cash.
And this slide right here breaks it down perfectly. I want you to think of the income statement, the one that uses accrual accounting, as a measure of effort. It's tracking the sales you made and the expenses you incurred, but it doesn't care when the money actually moves. But the statement of cash flows? Oh, that's the reality. It's the unfiltered, no-nonsense story of where cash came from and where it went. Getting this difference is the absolute first step.
All right, so here's our game plan. We're going to start with that why, that whole effort versus reality thing. Then we'll break the statement down into its three key sections, or buckets. We're going to spend extra time on the operating section using the indirect method, because I'm telling you, it's heavily tested. Then we'll cover investing and financing, and finally, we'll wrap it all up.
So how do we organize all these different cash movements without going crazy? Well, the good news is the statement sorts everything into three simple, super logical buckets: operating, investing, and financing. Just remember OIF. That's going to be your guide.
That's it. These are the only three categories you have to think about. Every single cash transaction a company makes, whether it's selling a widget, buying a new building, or paying a dividend, is going to fall neatly into one of these three buckets. Simple as that. Okay, first up, operating activities. And I want you to think of this section as the absolute heart of the business. It is its lifeblood. This shows the cash coming in and going out from the company's main day-to-day business. We're talking cash from customers, cash paid to suppliers, cash paid to employees. A healthy company has to be generating positive cash flow from its operations, period.
Now, I need you to lean in and pay close attention here, because I can tell you from years of experience, the CMA exam loves to test this next part. When we're figuring out cash flow from operations, we're going to focus on what's called the indirect method.
You see, there are two ways to do this: direct and indirect. The direct method is easy to understand. It literally just lists cash receipts and cash payments. But the indirect method, and this is the one you'll see almost all the time, it's more of a puzzle. It starts with our net income, our effort, and then it makes a bunch of adjustments to get us back to the reality of cash.
And where does this puzzle begin? Right at the bottom of the income statement, with net income. We grab that accrual-based profit number, and we use it as our starting point. From there, our job is to clean it up, to figure out what the actual cash number is.
So, how do we do these adjustments? It's really a two-step process. First, we deal with all the non-cash stuff. We have to add back expenses like depreciation, because, think about it, even though it lowered our net income, no cash actually left the building. We do the opposite for any non-cash gains. Then, second, we adjust for all the changes in our working capital. So, our current assets and current liabilities.
And for those changes in working capital, this right here is the golden rule. You need to burn this into your brain. If a current asset, like accounts receivable, goes up, it means your customers haven't paid you yet, right? So your cash is lower than your reported revenue. Cash goes down. But for liabilities, it's the opposite. If accounts payable goes up, it means you haven't paid your bills yet, so you've held on to your cash. Cash goes up. Master this relationship.
Amazing job on that operating section. I'm telling you, that is the most complicated part by far. The next two buckets, investing and financing, are much more straightforward. Let's take a look at how the company is building its future and how it's paying for all that growth.
Investing activities are all about a company's long-term assets. This is where we see them putting money to work for the future. Do they buy a new factory? That's a cash outflow. Do they sell off some old equipment or maybe some stocks they owned at another company? That's a cash inflow. Simple as that.
And finally, we have financing activities. This bucket answers the big question: how are we paying for everything? It tracks the cash flow between the company and its owners and its lenders. So issuing stock or taking out a loan brings cash in. Paying dividends to shareholders, buying back your own stock, or paying down debt, all of that sends cash out.
So we've worked our way through O, I, and F. We've filled our three buckets. Now, how do we know for sure that we did it all correctly? Well, this is the beautiful thing about the statement of cash flows. It has this amazing built-in self-check to prove our work is right.
And here it is, the final check. You just take the net cash from all three of your sections, operating, investing, and financing, and add them together. That gives you the total change in cash for the period.
You add that to your beginning cash balance from the start of the year, and it must equal the ending cash balance you see on your balance sheet. It's a perfect reconciliation. If those numbers match, you know you've nailed it.
I know that was a ton of information, but here is my biggest piece of advice as you prep for your exam. Please, don't just memorize the rules. Focus on understanding the why. Why does an increase in inventory make cash go down? Why is paying a dividend a financing activity and not an operating one? When you really get the logic behind it, you can handle any curveball question they throw at you. You are more than capable of mastering this.
Because really, that's what this is all about. You're not just learning a bunch of accounting rules. You're learning how to read a company's story. It's a story of growth, maybe some struggle, of investment, of strategy, and it's all told through the movement of cash. Keep practicing, be kind to yourself when you get something wrong, and just keep moving forward. You've got this. I'll see you in the next one.